Hello, everyone. Thank you very much for joining us today. My name is Corey Daharsh. I'm with Advanta IRA. I'm joined today by Kent Ritter, and we're here to bring you the topic of how to analyze and invest in a specific market. So this is mostly a real estate centered investment webinar. Again, Advanta IRA is the company that's putting this on, and my guest speaker today is Kent Ritter. He is the CEO and founder of Hudson Investing and the host of the Ritter on Real Estate podcast. I've been connected with Kent and his team for a number of years now. I've done a session on the podcast with one of his colleagues, Kurt, a few months back. Kent, so happy to have you here. Thank you very much for joining me and bringing some of your educational expertise to the table.
Yeah, absolutely. Thanks, Corey. Excited to be here today and excited to, just share some knowledge that's hopefully helpful with everyone.
Awesome. Well, we're going to get to Kent's portion of the presentation a little bit later. First off, I'm just going to cover today's agenda and some basic information about Advanta and self-directed investing. So just so everyone has a broad scope of what we're looking to cover today, the gist of what is a self-directed retirement account, what the process is to get one of these accounts started, and how easy it is to get them funded and ready to go. And then I'll have a case study or two about how to make real estate investments with your retirement account. And once I finish that portion, I'm going to turn it over to Kent, and he's going to go specifically into analyzing and investing in specific markets. Then we'll end with any final questions and a conclusion. But as we're going, I would like you all to know that you'll be muted for the duration of the webinar, but we do want your participation. So please feel free to use the questions box in GoToWebinar to jot down any questions. If they relate to the presentation, I will ask them as we go to Kent, or I'll answer them myself. And if they do not relate specifically, then we will cover those at the end. One other tidbit is that we do have a PDF handout attached of the slide deck. So if you're interested in that, you can feel free to review that at your convenience. So just to get us started, Advanta IRA is a self-directed retirement account administrator. We've been in the industry for 20 years now. We've got about 10,000 active clients and just over $2.5 billion in assets under management held by our clients. All of those funds that are not actively invested are insured up to FDIC limits, and every client we have is paired with a dedicated client account manager, so a one-to-one person that you can reach out to as a client of ours and not have to call a large wire center or a large call house when you have any specific questions or needs. You really get a personalized touch with that. I served in that client account manager role for about 5 years. That's where I first got my introduction to Kent and his team at Hudson Investing. And now in my current role of education and networking, it's just something I can build off of. And our team builds off of learning how to help our clients in their various investment avenues and interests as well. So a brief disclaimer, all of the information you're going to see today is for educational purposes. We do implore you to consult your own CPAs, attorneys, advisors before making any type of investment. And again, I'm going to have some case studies later on in the presentation. They're rounded numbers. They're realistic, but it's just very simply put, rounded numbers to make you see what the picture is for the investment. You'll obviously need to do your own due diligence before making any specific self-directed investment yourself. So if you've not heard about self-directed investing, that's actually very common. Only about 4% of US-based retirement accounts are self-directed. So in the grand scheme of an industry that's got about $40 trillion floating around, only about 1.5 trillion or 4% are people taking advantage of self-directed strategies. So it's something that at Advanta IRA, we hold a high value in spreading information and knowledge and education about self-directed investing so that more people can learn, either take advantage of it themselves or let friends and family know that this is something that may be viable for those that have retirement accounts and maybe just are not so comfortable with the stock market or other assets that they'd otherwise think they were limited to investing with. And that brings me right to my next point here. Why do people choose to self-direct? Well, it's either a new source of capital, so someone's already making some sort of investment strategies in their personal life, and then they learn, oh, I can tap into my retirement dollars to make these same investments in a tax sheltered or tax-free capacity. There's a lot of people that are tired of the stock market, going up and down, or more so down over the past few years. And then the tax benefits. Again, with real estate specifically, there's some great tax benefits to making these investments with your tax sheltered dollars. If you're doing a real estate investment, there is no capital gains on the sale end of the transaction, and a few other benefits that happen when you do those types of deals with your retirement account as opposed to your personal savings or other monies that you have available. So what is a self-directed IRA? In itself, it is a retirement account that you can invest however you want to without a custodian or fiduciary custodian, financial advisor, telling you what you can and cannot invest into. So Advanta IRA, simply put, are experts in what the IRS rules are as to what you're allowed and not allowed to use your retirement account for. And we let you make the ultimate decision on the self-directed investments you'd like to make. There's a few different asset classes listed here on this slide, but again, we're focusing a bit today on analyzing specific markets for real estate investing. So we'll cover more leaning into the real estate side of the market, which honestly is about half of our client base, if not a little bit more than half of our client base are in some way, shape, or form real estate investors. So the different types of plans that can be self-directed are pretty much all of the retirement plans in the US. Most people are familiar with a traditional or a Roth IRA. Those are non-employer tied accounts. Anyone in the US can have a traditional Roth IRA. Your ability to contribute into it is just based on your earnings, your ordinary earned income. And those are basically the standard accounts. But we also have SEP and simple IRAs and solo 401k plans for small business owners, and health savings health savings accounts and education savings accounts for people with high deductible health policies or young ones in your life that you'd like to set aside some money for in a tax shelter capacity, educational expenses that carry them through elementary and primary school all the way through graduate and postgraduate studies. And any money left in those Coverdell education savings accounts, once the person in question has finished, can be handed off to like a next of kin. So that money can be handed off if needed to another relative that has educational expenses. Some great products that aren't well known, but we do offer them, and I'd be very happy to expand some information and share with you some details about those. So the rules about self-directed investing, again, Advanta IRA has a staff that are pretty full of what's called CISP, designated professionals, or certified IRA service professionals. I've had my designation since 2018. A lot of our staff gets it. It basically means we're experts, again, in the IRS rules. Very simply put, what you cannot invest into in your retirement account is a life insurance policy or hard to value collectibles like antiques, fine wine, artwork, those types of assets. As long as it's not of those categories, you can likely hold it in your retirement account. You just may have not known otherwise until now. And the only other way the IRS restricts how you use these accounts is by labeling certain individuals disqualified persons. Those are your family members that are on your family tree, whether it's your parents, your children, your grandchildren, anyone up or down your lineal tree. Any businesses that those individuals own 50% or more of are also extensions of disqualified persons. Now, you can't sit on the opposite side of a transaction from a disqualified person, but you can partner with them. Just to make sure I'm clearing the air on that, I've got a few examples of disqualified transactions. If your IRA purchases a piece of real estate, you can't buy it from your son or from your parents. If your IRA owns a piece of real estate, the relative that's disqualified can't be a tenant or can't do any equity of sweat equity on the property, like any manual labor or anything like that. Again, just a few examples of what would be disqualified. We're here to cover those bases for you and answer your questions as you're prospecting your investment transactions. Moving money into these accounts is very simple. You basically just do either a custodian to custodian transfer, which means you have an IRA somewhere else and you want to start self-directing it. That is a non-taxable, non-reportable event. You just fill out one form for the company you want to take in the account. They submit it to the company that currently has your money, and it's usually facilitated within about a week. The other way to move money into these accounts, which is also generally a non-taxable event, is what's called a rollover. Most cases, a direct rollover specifically. That means you've got a former employer plan or a current employer plan that you're eligible to do an in-service rollover out of, and you do a distribution out of that plan, which is reported to the IRS, And then as long as you roll that money into another qualified plan within the allowable time frame, which is typically 60 days, you are eligible to do that. The rollover into the qualified plan is reported to the IRS as well. And as long as those dollar amounts are the exact same, there is no taxable consequence for you to move that money out of a managed account into a self-direct account. The rollover process, because it usually involves a check being cut and mailed out, typically takes about 10 to 14 days roughly. So all in all, if you're someone looking to start a brand new self-directed account and you have an investment already on the table that you're looking to do, a conservative estimate is that you should give yourself, from the day you complete your application, roughly 2 to 3 weeks as a comfortable estimate before you expect to have the deal funded, the document signed, and the actual investment transaction completed. So again, with real estate assets, what different options do you have? Well, you can hold single family or multifamily homes for rental income. You can do fix and flips or short-term properties, wholesaling, option contracts, tax deed and lien investing, and syndication investing, which is really kind of mailbox money. Syndication investing in itself is where you do the prospecting on a specific group that's putting a deal together. Hudson Investing, for example. You read through all the paperwork, they're going to do all the legwork, they just need funding, and that's what you would use your retirement account for. I've got a case study that goes over either holding a piece of real estate and or making a syndication investment that I'll get to in a little bit. So with buying real estate, this is actually taking deed of title on a piece of real estate in your retirement account. The property is purchased in the name of the retirement account. All of the documents flow through the retirement account administrator. So you have to approve everything, but it's all executed from Advanta IRA on behalf of that retirement account. And all of the income and expenses flow straight through your retirement account. And that's either tax deferred or tax free funds that are being generated as you generate income. When you have a piece of property in your retirement account, it's important to understand, again, the disqualified persons rules. You and your disqualified persons cannot do any sweat equity. So for the flippers out there, at the very least, you need to have a trusted third party like handyman or someone that you can trust that's not a disqualified person or yourself doing the labor. It is something that you do not have to have a certified plumber or electrician. You can just use a handyman. Again, the key here is that they're not disqualified persons to you if they're doing any work on your retirement owned property. Renting the property is completely up to the account holder. The account holder sets the terms, determines who and how they want to rent the property, and they go ahead and coordinate that by providing the lease agreement to Advanta with their approval. We execute it on behalf of the retirement account, and then that agreement is then binding. Another way you can do this is actually employing a property manager. That's completely a client's discretion if you want to have a property manager do some of that middleman work so that you're, as the account holder, not necessarily serving as what I kind of equate to a general contractor in the grand scheme of things. Have a property manager do it. They're going to charge their rate, which will be paid out of your retirement account, not out of your personal pocket. And then again, just kind of hitting this home, when you have expenses in an account like this, you do need to have them flow through the retirement account. Nothing should be coming in or out of your personal pockets. We have a 24-hour online portal you can access to submit payment requests or billing requests. We can also have an authorization on file for your standard utilities. So as soon as the utility bill comes in, we automatically pay it out if you've already authorized us for, your electric company, your water bill, those types of recurring maintenance items for your property. I'm going to actually skip case study 1 because I did just cover a lot of detail right there on physical real estate. I'm going to leave this in the slide deck. So again, if you pull the slide deck from the handout section or you reach out to us for the slide deck, you can review that case study directly. I'm going to jump into case study 2, which is investing into a syndication, before I turn over to Kent. So investing into a syndication basically works where we've got Larry, who is a retirement account holder, and he meets Malcolm, who is a syndicator, or a general partner is another term commonly referred to in that world. And Malcolm has a deal. Larry and Malcolm meet, they talk over the deal, and Malcolm provides Larry all of the investment paperwork. He reviews it, does his due diligence, decides he wants to make an investment. So he goes ahead and sets up a self-direct account, does a custodian to custodian transfer request, as I mentioned earlier, to move the money needed for this deal into the self-direct account. And Advanta coordinates all the paperwork with Malcolm, getting Larry's approval and making it a very smooth process for all parties involved. So again, the deal is funded and the subscription paperwork is in the name of Larry's retirement account. It's tied through a tax ID number for the retirement account and not Larry's social security number. And in the grand scheme of things, once this deal runs full cycle, just for example's sake, the partnership pays an 8% preferred distribution on a $50,000 investment. That's $4,000 a year. After the 5th year, the project's refinanced and a $65,000 final payout is sent. So Larry's IRA effectively generated $35,000 of either tax deferred, meaning he pays taxes on that money when he distributes it later in life, or completely tax-free income if that investment was made through a Roth component 401k or a Roth IRA account. Advanta IRA, as I said earlier, does try to put out a lot of educational content. We typically do 2 of these educational webinars a week. We have our own podcast called the Alternative Investing Advantage Podcast you can check out. We have a blog on our website if you're interested in the industry standard news, like legislation involving the retirement account industry. So please check us out for anything else we can do to help you. Our application takes about 15 minutes for most people to complete. You, again, can get your account funded and started, ready to invest within roughly a week and a half to 2 weeks. And without further ado, I am going to give Kent the control to navigate the slides here right now. And Kent is going to take over and share with you guys how to analyze in a specific market and make an investment based on what your goals are, what your strategies are, and where you want to invest your retirement money. Kent, the floor is yours.
Thanks, Corey. Appreciate it. And yeah, thank you everybody for coming today. So excited to have you here and share some valuable information with you. As Corey said at the beginning, I'm going to share several slides here. As questions come up, please feel free to, I think you hit the button there to be able to ask a question, and we'll kind of take those as they come in. But happy to have a little bit of a dialogue to clarify anything that I can. So let's jump in here. There we go. So a little bit about me. Husband and father of 3. You can see the family there in the picture. And my why is really that I want to live in a world where more people are financially secure enough to be able to pursue their dreams and passions. And that really was central around founding Hudson Investing, because at Hudson Investing, we really serve 2 roles. It's provide education and provide access to great real estate investments that most people wouldn't traditionally have access to. And the education component, which is why I'm here today, is so important, because I find that one of the biggest barriers to folks making that first investment is just lack of information or misinformation around real estate investing and what that is and what that means. There's when I started, really what I thought real estate investing was going out and buying a single family property and becoming a landlord, right? Because that was all I knew. That was all that I had been exposed to in my life. And as I educated myself and really understood the whole world of commercial real estate investing, it really turned me on to just a higher level of investing, which is what we do now, which is syndications, which Corey described, which really at the end of the day is just pooling money together. So instead of myself just investing, myself and maybe 50, 60, 100 other people all pooling our money together to go and purchase a property that's bigger and better than any of us could individually. And that's how we go out and we buy large apartment buildings, which have economies of scale and just a lot of benefits that just from a downside protection standpoint and an upside potential standpoint, in my opinion, far exceed other options in investing from a risk and return standpoint. And so that's why as I evolved as a real estate investor, starting in 2014 with those single families and the fix and flips, as I evolved into these large apartment buildings, which is what we do now. Corey also mentioned, and I'll reiterate, I'm a host of the Ritter on Real Estate podcast. It's everywhere that you listen to podcasts. It's really focused on, again, education, helping people understand how these commercial real estate investments work. So we remove that barrier to entry of just that uncertainty. My goal is to give you the clarity so you can confidently make investments as they come up and confidently evaluate those investments. And so that's part of what we'll be talking about here today as well. So a little bit about Hudson Investing, my company. So founded Hudson Investing in 2019. So again, started in 2014, really as a side hustle, if you will, right? And advanced to 2019 to realize this was my passion and I wanted this to be my career for the next 30, 40 years. Founded Hudson Investing. We're headquartered in Indianapolis, Indiana. We have 8 employees. We've acquired over 100 million in assets, 112 million, and we actually are closing on a property today, which is exciting for us. It's our first property down in South Carolina, 156 units. And then we've got currently about 84 million in assets under management. So, we've got a good level of experience. We've acquired over 1,000 units throughout the Midwest primarily. And, so today my goal is to bring a lot of that knowledge to you, and you can move to the next slide, Corey. But to bring that knowledge to you and try to give you some insights into how we look at investing, how we look at markets, how we look at deals, and then try to distill that into some of the key components that you can take away. Just a little bit of that understanding to help you be a better real estate investor, whether you decide to do it yourself or you decide to invest with someone like me. So as we look at investment markets, the dark blue are the markets that we are currently targeting. And this is a broad use of markets, really looking at the states. These are the states that we currently invest in. And just down the side there, you see kind of just a hierarchy of things that we look for, right? In investments that we like. Now we take every year we go through a process to identify which markets we want to be in, really at the city level. And we have about 21 drivers that we will look across to evaluate any market. But really, as you roll things up, major trade crossroads, high absorption rates, and low new construction. So absorption just means that our apartments filling up as they come online, or our apartments being delivered and built and people are not moving in, right? You want to see positive absorption, meaning people are moving in and renting faster than apartments are being delivered. Large supply of a skilled labor force, and that goes into a lot of things that we'll talk about later. But really, when you look at jobs and the workforce, that's the number one thing that you're really going to want to look at. Positive net migration means more people are moving in to the state or city than out, right? It's growing, and high rising tides raise all ships. High upside in rent affordability, meaning that rents are relatively affordable, meaning that there's opportunity to increase rents, and people will still be able to pay. And then you want really a higher barrier to entry to owning a single family home, which nowadays more than ever, the barrier to entry hasn't really ever been higher as you look at where interest rates have gone. And so that not helpful for us largely as an economy and society, but helpful as a multifamily investor, because what that means is people will rent longer as they try to save up for that down payment. And obviously housing prices vary widely from different markets, so it's something to really understand what that barrier to entry looks like. And you can move on to the next one. So this is just a snippet of our market analyzer. So what we'll do is, like I said, 21 primary drivers. Those are really quantitative data points, right, that we'll look at. And what we do is we feed in a lot of data from different sources into this spreadsheet, and then we rank and file the top cities in the country And we come up with really a composite ranking or a weighted average and the cities that rise to the top. So this one was from the beginning of 2022. And obviously the spreadsheet's much bigger than this, but just wanted to give you some insights into how we look at it. So we take these 21 quantitative metrics, rank and file, and then there's a whole nother about 20 or so qualitative components that we layer on top of this to decide which markets each year we want to enter, we want to stay in, or we want to exit. And so, you'll start to understand as you look at this, really, you want to be looking at markets first before you get down to a specific investment. I think where a lot of people, when they start, go wrong is you spread yourself too thin, you cast your net too wide. And really, to be a successful real estate investor, you have to become an expert in your market. So if you're looking at too many markets, too many cities, it's just impossible to build that expertise that it takes to be really successful. So as I was thinking about this and thinking about, even beyond investing in a specific market, I was thinking about what is the thought process that someone needs to go through as they decide to become a real estate investor and as you evaluate deals. And I think really where a lot of people waste time because they lack clarity is in the goals and strategy. So you have to make sure you're clear on your goals, right? Is your goal to have cash flow and steady cash flow, right? Because maybe you're retired and you want to supplement, or you want to supplement an income stream. Is your goal to just build wealth and therefore you want appreciation? Because cash flow and appreciation usually they usually move inversely from each other. For example, a market like Los Angeles is going to have very little cash flow in a lot of real estate investments, but high appreciation traditionally. Whereas a market such as, let's say, Indianapolis, where I live, much more cash flow focused, less appreciation over time. And so it's a different value, and but you can see how that determines market and then a lot of other things that come through that. And then you've got to make sure, so that's just one example. Another goal is, well, do you want to be active in this, or do you want to be passive? Do you want to do it yourself and potentially have the reward of a higher return, or do you want to put it on autopilot, invest with someone like myself with a team of experts who lives, breathes, and does this every day and just loves it, and just have the mailbox money, as Corey said, coming in for a different return profile, right? And so you have to, I think, get clear on what your goals are, how active you want to be, and the goals also determine what type of asset, right? When you think about, there's lots of different ways to invest in real estate, from triple net leases to owning retail like a strip mall, to owning an office building, to owning multifamily, to owning industrial like a warehouse. These are all very different types of investments that have different return profiles, different risks, different rewards, and you need to make sure that whatever you're doing aligns with your goals. But I think you have to get clear on your goals, and you really have to get focused, because again, the risk is spreading yourself too thin and trying to do too many things. I think that's often where I see people really never get started there. So I think goals and strategy. From there, you need to figure out, so if your strategy is you want to do it actively on your own, then really you go down to the market and then the team, and your job is to figure out the markets you want to be in, and then you need to start building a team in those markets. And we'll talk more about that in a second. If you decide you want to be passive and you just want to have somebody else focus on this and send you those checks quarterly, then you need to find sponsors like myself. It's kind of the term they use for the people that lead these investments and bring others in, but do all the work, right? So it's finding the sponsor, and then that goes down into the market, right? So, and I say find the sponsor first, because really, if you are going to do it passively, that is the most important component. You're really finding someone that you trust, that you resonate with, that your goals align with, that you want to be partnered with for 5, 7, 10 years, depending on how long the investment lifespan is. And so I think it's really important to do your due diligence on the front end because those sponsors are going to be the ones that bring you the deals, right? And give you that deal flow to be able to make those investments. But you've got to build those relationships. Then the market, when we get down to market, and certain sponsors will operate in certain markets, and so that will help define market for you. But market really means the city or the surrounding area, right? And then you've just got to, again, decide based on your goals and strategy. It's going to also help you decide which markets align with those goals and strategies. And then you get down to building your team. And this is so important because I think what people often do when they get started is they go right to the bottom and they start with the deal, the property, right? Because they have an investment. Usually these investments come out. We will send an email out to our mailing list and say, here's an investment opportunity, right? And it's for a specific property. And people start there, and you may end up wasting a lot of time because, or if you're doing it yourself and you're just reaching out to brokers and they're sending you a ton of deals, well, you're going to waste a lot of time because, we can disqualify about 70 to 80% of the deals that come to us because we're very clear on our goals, our strategy, and the markets that we want to be in. So if the deals don't align with that, we're able to quickly push those off to the side to only focus on what matters. Early on in my career, I was definitely guilty of this, where I would just, every deal that came into my inbox was like a new shiny object, and I would want to spend the time underwriting it, which if you're doing it right, could take easily 4 hours if you're good at it. And you just get to the point where you can't make decisions fast enough. So the whole point in focusing on the market first is it just lets you reduce a lot of the noise. Because if a deal comes in, it's not in a market you want to be in, you don't have to look at it. You get down to team, and team is another place where I find people are just behind the 8 ball. If you've got a deal under contract, if you're doing it yourself, you get a property under contract, you have 30 to 60 days to close. And if you don't know who your team is in that market, and team's under market because your team will be different by market, right? But your team is your property manager, your accountant, your attorney, right? Your insurance broker, which are more important than ever. All of your contractors, right? All of these people make up your team. They're going to help you have a successful investment. Those people need to be there from the start before you have a deal. Otherwise, you're just behind the 8 ball, and it's going to make it really difficult to be able to close on time. Then we get into submarkets. Submarkets really now what the different neighborhoods, different areas of the city. And so if you want to be in that market, you got to do the research. Okay, but is that the area of the city you want to be in? Is that a good area or a bad area, right? Wrong side of the tracks, right side of the tracks. And then you get down to property. So, okay, it's in a city I want to be in. It's in the part of the city I want to be in. Is this a property that I would want to own, right? And we'll talk about details around that. And then lastly, I put deal because, especially if you are partnering with someone else, and you're being active, or you are working with a sponsor, right, for a syndicated deal, right, and you're passive, then you may love everything to the property, but do you like the deal, right? Does the debt they're choosing align with your goals and strategy, right? And do the fees that they're charging, and the return profile, does that match, right? So is it a good deal at the end of the day? And we'll talk through, more what that means as well. But just thinking about this hierarchy, if you could start at the top and work your way down, it will really save you a lot of time and make you much more efficient.
And Ken, as we're moving to the next slide, I do have 2 questions here.
Sure.
First is about the goals and strategy, and relative to your position kind of as a deal sponsor and a syndicator. When clients are prospecting, if they find a syndicator or a deal sponsor that they like, are they always going to see that sponsor have the same type of strategy profile or goals? Or even, within a sponsor, do they check out and try different deals based on the specific market conditions or specific details? Like, are you hyper focused on a specific, um, appreciation strategy or cash flow strategy, or do you kind of diversify based on what the actual needs are?
Yeah, good question. I would say, and I'll speak broadly, among sponsors. Usually, sponsors have a particular flavor, right? Like you'll have a developer, they build things ground up. You'll have someone who does value add, meaning they buy a property that they believe they can improve and therefore add value, but it's an existing property. Or you could have sponsor, so sponsor, you could have sponsors that buy land, right? And buy and sell land, lots of different things. So usually there will be a flavor. Now I can tell you the other thing I would say is that I think as a good sponsor, you have to adjust. So sponsors will likely have an expertise in one, maybe two areas, okay? But you have to adjust to market conditions. I mean, I think if you were deploying the same strategy today, if I was that I was using 2 years ago, that would not be good. That would not be a good investment. I mean, the world has changed so much that you have to look at things differently, and I think you have to be able to adjust, and that goes down to the type of debt you choose, the hold period, the type of properties you're going after. I think the sponsor should have a clear thesis around why they're investing and what they are based on the market, the dynamics, the economy that we're in, and they should have a clear vision on where they expect things to go, because these are typically 3 to, I would say, up to 10-year investments. Ours are typically about 3 to 5. And so you need to have a pretty clear vision on where you think things will be in 3 to 5 years. No one has a crystal ball, but you've got to have at least a compelling vision to go towards. So I would say that everybody will have an expertise or flavor, but you have to adjust based on the market. For example, we just did our first ground up construction project. We kicked it off earlier this year. We have investors in that deal. We had not done a ground up construction. Everything we had done before that was value add, but I saw the opportunity because of where the market is in the particular town where we did it. They needed supply, and so we saw an opportunity to build there. And so I think you have to, just as a sponsor, you always have to be looking for opportunities. And I think that's really what you're looking for, someone that can find opportunities and create opportunities as a deal sponsor. So.
No, I think that's a great synopsis, and really kind of a peeling back of the curtain for the audience to know, like, you're not specifically hyper focused, but as you said, I think the specific term you use is there's a specific flavor that you may have an interest in as a sponsor. So kind of vetting that out in itself for an investor is a great way to get started. One other question here as I advance to the next slide. Someone asked, are you still bullish on Austin, Texas? If so, why? I don't know if you want to maybe hold that in your pocket for a little bit further on, but I noticed the next slide was specifically top market drivers. So take that with how you'd like it.
Yeah, for sure, for sure. So yeah, I'll reference that kind of here as we talk through this. So yeah, so now what we want to do over the next few slides is, I told you guys we have a list of 40 something drivers that we go through, right? I really tried to distill it down to what are the top 5 as we go from market, submarket, property. So when you look at market, and these are the things that I think if you could only look at 5, this is what I would look at. So for a market, right, job growth is going to be number 1. Job growth is what is going to bring people to that market and create and provide opportunities for people in that market. If there's growing jobs, employers are going there, then people will follow and they will need housing. So, if I could only look at one thing in a market, that's what I'm paying attention to. Next is population growth, right? But really one moves the other. Typically, it's really jobs, and that leads to population. But you want to be in a market that's growing. You don't want to be in a market that's contracting. right? And just the idea of rising tides raise all ships. The market vacancy. So you've got to pay attention to what is the vacancy in the overall market. Again, because it's what are the if the overall market has low vacancy, it means a lot of apartments were just built and brought online. That means that people have more options and places to live, right? And if there's too much supply, what does that mean, right? It means prices go down. It means rents go down. And the worst thing you can have on a property is high vacancy. I mean, as owners, we are always hyper focused on maintaining occupancy at a high level. And so you want to look, if it's a market where the overall vacancy is not good, it's unrealistic to think that your property is going to be able to outperform the market significantly. I mean, you may think, oh, I can better market, I can do better marketing, I have a better property, better all of this, but you can only outperform so much the broader market. So you just want to pick markets that are growing. Forward-looking unit absorption. So this really means based on what's under construction, what is planned to be under construction, how much is being delivered based on how much demand is expected, and is that positive or negative? Are more apartments being delivered than people to rent them, or more people coming than apartments available, right? You can understand how those dynamics really affect your ability to increase rents and increase your profitability. So I think it's really, to me, and this goes, I think, right to that Austin question. You've got to really look at the supply and demand dynamics in the market. There's a lot of top markets right now where there's massive supply gluts coming in. I'm not very familiar with Austin, to be honest. I mean, I know as much as the headlines and people I talk to, but I don't invest there. Nashville, I can relate to Austin, though. They're very similar in their growth trajectory. Whereas I know right now, Nashville, Tennessee has 15% of the total supply being built right now. So for the next couple of years, they're going to add another 15% on top of what already exists there from a supply standpoint. I think it's really tough to meet that demand in the near term. And so largely what you're probably going to see is occupancy dip and rents dip, for a few years as things catch up. And then lastly is employer diversification. So, you don't want all your eggs in one basket. So if you're in a town that has one employer, and then that employer leaves town, well, you're in a tough situation. So you want to see lots of employers. You want to see employers in different industries. And ideally, you want to see non-cyclical industries, such as, if you think of things like defense, you think about healthcare, you think about government, you think about higher education, things that are typically non-cyclical, meaning they're not going to ebb and flow with market conditions. Next one is dipping down into the submarket. So submarket, now we're talking about neighborhoods, right? This is a map of Indianapolis and the different neighborhoods. When you get down to so you're like, okay, I want to be in this city. Where in the city do you want to be, right? Because the north side could be very different from the south side, for example. So you want to look at things like median household income. That's going to be your determinant of, can they pay the rent that you plan on charging? You want to look at competition vacancy. So we talk about market vacancy, right? When you get to this level, you want to look at who's your direct competition and what's the vacancy there, because the market as a whole might be 95% occupied, but in your pocket, maybe it's only 85, right? Because maybe there's a reason people don't want to live in that submarket. Maybe it's close to a prison. Maybe it's close to a toxic waste site. You got to just understand, or is it one of the best places in town in the path of progress and everything's 98% occupied, right? You got to understand the different vacancies. You want to look at median home prices, because those differ by parts of town too, right? And again, you're looking for that barrier to entry to getting that home, because people will rent longer. You want to look at crime for obvious reasons, and you want to look at schools for obvious reasons. There's really mainly two places people live where they do. First is jobs, and second is schools. So you want to make sure you understand how good are the schools in that area, and is it a positive to where people would want to live there, for example. And then, okay, so you want to invest in that part of the city. Now we got to find a property, right? And so I keep hitting on occupancy. You want to know what's the property occupancy. If the property, and you want to compare that to the competition occupancy. Is it lower or higher? If it's higher, is it because the rents are way below? If it's lower, why? And if you don't have a compelling story to tell of why the rents are lower, then you should not invest in that, because if occupancy, or excuse me, if occupancy is lower, and because if you can't find the reason and identify it, and you can't fix it, then it's difficult to believe that you're going to be able to increase the occupancy relative to the competition, right? You want to look at collections. So that's another thing where I often see, especially new folks, get caught up is, oh, physical occupancy is great, it's 98%. But when you look at the financials, well, maybe 15% of the property are not paying their rent, right? And so you got to look at collections. I mean, it doesn't matter if somebody's in the unit if they're not paying rent. You want to find properties with below market rent. So for what I do with value add, right? We're buying a property that has been there for 20 or 30 years typically. And we know that it's got below market rents, and we can clearly see why the rents are below market. Typically, it's got deferred maintenance, the units haven't been improved, it's got bad marketing, poor management. When we lay out a business plan, we identify those things, and we say, these are the reasons that we believe we can do better, and we can then raise the rents. And you're always keeping track of that rent to income ratio, which again is, you go back to the rent. I told you got to understand the median household income. So it's again, how affordable is the rent? And HUD, Housing and Urban Development, they define someone as rent burdened if they're paying more than a third of their gross income in a month toward rent. They say that's more than that is unsustainable. And so, the reason that I like markets in the Midwest is because usually that's much lower. Usually people maybe are paying only 20% of their gross income to rent. And so that you can come in, you can improve the property, you can raise rents, and people will be able to afford it. Next, property age. The older the property is, the more likely there's going to be issues and things that go wrong, especially properties that were built pre-1980, just construction processes really improved in the 80s, and then again, kind of 2000s. But also right now, what you really have to pay attention to is insurance. I mean, there are insurers right now that just say, I will not insure anything that was built prior to 1990. And so you really have to understand how the age impacts your operating expenses and what you need to put aside for fixing things. And you just need to budget appropriately. Next, deferred maintenance. So that's just stuff hasn't been fixed, right? Maybe it needs bad siding, it needs roofs, all of those things. Look, if you can budget for them to fix them and your numbers still work and still a compelling investment, then it's not a problem. It's only a problem if it's things you didn't budget for and you don't have the money for. And so you just need to have your eyes wide open with deferred maintenance as you go in. But those for the market, submarket, property, those are the top 5 things I would look at as I'm making my investment decision.
And Kent, just real quick before I move on to the next slide, I just want to remind the audience, please add any questions you've got to the questions box. We've got a few slides left, and there is one question I wanted to bring up or really address with you, Kent, for the audience's benefit. You mentioned a few different times the context just of value add investing here on this slide. Can you just at a 30,000 feet level explain the different levels there, like C-class properties, and when you're doing a value add, you're trying to get that up to either a B class or even jumping it all the way up to an A. Can you just very generalistically explain that to the audience, please?
Sure. So when you think about real estate, you typically think about 4 classes of real estate: A, B, C, and D. D is going to be, an old beat up property in a bad neighborhood. Me personally, I would stay away from the Ds. Your A's are going to be your newest, nicest properties in great locations, right? Then your B's and C's are going to sit somewhere in the middle. Really, where I focus, and as we talk about value add, really it's thinking about, okay, can I take a C property and make it a C plus or even like a B minus, right? Or can I take a B property and turn it into an A property because I can add amenities. I can go from laminate countertops to quartz countertops. We can add stainless steel appliances, things like that. Really, the value add concept is just, like I said, it's seeing that the property is under market from a rent perspective, and then knowing that we can come in through better management and through renovations and through adding amenities, and we can improve the value of the property. Because the great thing about commercial real estate is it's valued based on the income it produces. So we can force appreciation, meaning as we increase the income, for every dollar we increase the income, we are going to increase the value of the property, 15 to 25x, depending on the market that it's in. So, by small increases in the income, you multiply them by 20x, become big increases in value. And so that's really where, and the ability to force that, not just rely on the market and what stuff around us sold for, which is how single family homes are valued, right? And how the house you live in is valued, right? What did the other things around it sell for? But we were able to really, based on the income and improving that income, force the appreciation is really where the power is in that value add strategy. And it's just the right blend for me of risk and reward, because value add kind of sits in the middle of, you have your properties that are maybe abandoned, right? They're not making money, they're distressed. That's on the farther side of the curve. That's much higher risk, maybe higher reward. On the right side, you have your core properties, which are brand new, nothing really to do to them, and you're just gonna hold them, and you're gonna get a little bit of cash flow, but they're new and safe. That value add sits right in the middle of that, and to me, it's that right mix of risk and reward, where the property's already cash flowing positively, but we think we can help it make a little bit more. Yeah, so just one of the last things I wanted to cover is really this due diligence before investing. And this kind of goes down into that deal level. So, okay, so someone like me sends you a deal, right? And you're like, yeah, I love that market. I like the submarket. It's compelling. I like the property. Well, then it really comes down to, okay, well, what are they going to do with the property and how are they putting that deal together? So I think it's really important to be able to first test the major assumptions. So major assumptions are like the exit cap rate, and I don't want to get too technical, but it's basically it's the multiple that the income is going to be valued at when you sell, right? And so is it going to be a 15x multiple, a 20x multiple, 25x multiple? You can see how a little change there makes a big difference on the expected sale price of the property. So that'll be the biggest thing that will move the returns, would be changes in that. So you just need to make sure that what they're saying the exit cap rate is realistic based on that market and that class of property. Those are the two things that really drive it most: the class of property and the market you're in. You need to look at, rent, other income would be things like pet fees, valet trash fees. One thing that we like to do on our properties is we actually add fiber optic internet, and we become the internet provider. And we instead of them paying Comcast or Spectrum, they pay us for the internet, and it's a great value creator. But looking at rent, other income and expense growth, occupancy, bad debt, and concessions, making sure those are realistic as they're projecting where things are going to be, right? Because syndicator, someone like me, is going to lay out a model. If you're doing it yourself, you should have your own model. Lay out a model where you're saying, okay, here's where things are starting, here's how everything's growing, here's how the income is going to increase, and then here's the multiple we're going to put on it when we sell it, and therefore in 5 years we expect to be able to sell it for this much. and we're all going to share in those profits. But if those assumptions are wrong, it can vary drastically. So it's important to test the assumptions and challenge the assumptions. Renovation premiums are saying, okay, we're going to renovate a unit and we're going to increase the rents because it's a nice unit, $200. Is that realistic, right? And those other things we talked about, rent to income ratio things are the things of how you'll know if it's realistic. Then you have your budgets for both operating expenses, your budgets for CapEx, capital expenditures, or really renovations. That's also, if the property needs a new roof, did they budget for a new roof? And is the amount they're budgeting appropriate, right? And then the debt type. So the type of debt that's going on, is it a Fannie or Freddie Mac loan? Is it a bank loan? What's the term of the debt? Is it 3 years? Is it 5 years fixed? Is it variable? Or is the interest rate floating the whole time, right? You want to understand that. And then your DSCR is your debt service coverage ratio. Essentially what that is it tells you how high the income is over what the debt payment is. So if you have to pay yearly, for simple numbers, $10 in mortgage payments, and your income is $12, right? Your debt service coverage ratio would be 1.2. That's about a minimum of what you want to see. So you have a nice cushion to where your income could reduce $2 and you could still pay your mortgage. And then, is a refinance included and what are the terms? I don't really like to see deals where a refinance has to happen for you to get the returns that you're expecting, because refinances are, they're not certain. Like right now, interest rates are just going up and up and up, and it's really difficult for people to refinance. So if I told you 3 years ago, hey, you're gonna get these returns, but I have to refinance, now I can't. I'm not going to be able to get you those returns. So the way we always look at it is say, hey, here's what it looks like if we don't refinance. If we can refinance, here's what it looks like, and it's better. It's the only reason you would refinance. But I always like to show people the deal has to be able to live on its own without a refinance. And then evaluating the deal structure. So again, what are the fees being charged? What are the project level returns? So those are the overall returns of the project. What are the investor level returns? So those are the investors going, what the returns are going to you as the investor, because, myself as a sponsor, I get paid through part of those returns. It's how I make money. Then you'll hear about things like a waterfall structure, preferred returns. So just understanding what that preferred return is. I think important to understand if the preferred return is accruing, meaning if it's not hit. So preferred return would be like, okay, we're going to give you 7% annually as a preferred return, meaning the first 7% goes 100% to the investors. Well, if it doesn't accrue and that's not hit, and we only got you 4% instead of 7, well, too bad. We move on. We get you 7 the next year. If it does accrue, then if I got you only 4, that 3% would move to the next year. I'd owe you 10 the next year. So it's important to know if that accrues. And then distribution expectations. So when are distributions going to start? How much you're expecting to get each year, because it'll vary. And I think really when it's going to start and how much are the two things to really understand there. But just some things as you get down to the deal, you should be looking at and asking about. And we can move on to the next slide.
Well, Ken, I've actually got 2 questions that came in during the due diligence slide here.
Sure.
I'll ask those for you and then move it on to the bringing it home slide. The
Great.
first one is where/which sources do you mostly collect this information? An example, how and where do you find the market vacancy, forward-looking unit absorption, etc. And then the second, just to give them both teed up for you, lot of discussion and projections around EV battery factory growth/build outs in southern markets that you invest in. Would love to hear your thoughts and if that is a factor in your investment analysis going forward. Thank you. Those are the 2, and I'll go ahead and advance the slide, let you cover those as you see fit, and go ahead and bring us home.
Cool. Yeah, both good questions. So just getting back to where we find the data, we spend a lot of money for the data that we have. We spend I guess probably $50,000 a year on data sources, databases, and things, to be able to bring all this data in, to be able to make great decisions. Now, I will tell you there are free versions of a lot of the things that we use. There's sources. So, I mean, a lot of the growth information you can find through census data. There's cheaper versions, like there is something called Neighborhood Scout, which you can use to it's great for sub-market information related to crime and schools and things like that. There's a Rentometer, which is a tool to be able to quickly look up rent comps in the area and what the competition rent is or average rents in the area. But tools we use are like CoStar, RealPage, Yardi, ESRI, which is kind of a geographical database. Tools called RedIQ is another one, but there's there's probably free versions or other examples you can use, but yeah, the data is expensive and it's important to have good data at the end. I mean, that's what's driving your investment decisions. And so I think that that's something where we really invest a lot in that and kind of have a leg up against just the individual investor, and just being able to quickly understand markets and be able to quickly identify opportunities. On the EV side, yeah, I mean, I think advanced manufacturing in general is a great trend for the US right now. I think trends on, so one example of that are these EV battery plants, right? I mean, we know electric vehicles are coming. There's inconsistency around when, but absolutely it's the way we're going. If you look at countries like China, they are way ahead there in what they're doing, but I think they're kind of an example on where we could go with electric vehicles. So I think that's a great example of identifying some advanced manufacturing, which the US can do very well in southern markets where labor is cheaper. And the deal we're closing today is in Spartanburg, South Carolina, and there's one thing that's right outside of Spartanburg is BMW's North America headquarters, where BMW is investing in EV technology and many other things. And that's one of the reasons that we love that area. And so I think that's a great way to identify. I can tell you another property I purchased just outside of Indianapolis was because Eli Lilly, which is one of the major drug manufacturers, announced that they were building a $2 billion manufacturing facility in that county, where they're going to produce six lines of drugs. And so I think finding those nuggets is a great way to be on the front curve of activity in that market, and to be able to create a lot of value. So as we bring it home, so just to wrap it up for you guys, we talked about understanding your goals. Again, I just think being clear on your goals will save you a lot of time and a lot of headache. And the last thing you want to be in is in an investment with a time horizon, return profile, distribution profile that is misaligned with your goals, because you just won't be happy. You've got to educate yourself. I think even if you want to be a passive investor, as you can tell, it takes a lot of education on the front end. It's education, it's networking. It takes a lot, because one of the great things about real estate is that it's an imperfect market, right? Different than the stock market. There's a lot more information out there. It's at your fingertips, so everybody has the information, and a lot of it's priced in. Real estate, there are these opportunities to create outstanding value because not everybody has the information, not everybody's doing the work. And so I think educating yourself is really important. Pick an asset class that aligns with your goals. We talked about that. Decide if you're going to do it yourself or invest with an expert. That's a big part of your strategy, right? Figure out which markets you want to invest in. The network to find either sponsors that are investing in that market, or build a team in that market, right? Build a team before the property. If you're finding sponsors, then we have the teams in place. That's one of the reasons you're going to us. Do the work up front to be prepared when a deal comes. So, I always hate when, like I said, when we get a deal under contract, that deal usually closes in 60 to 90 days. And I always hate that there's always a percentage of people that are kind of just stuck in analysis paralysis, or just didn't do the work up front, and they miss out on the opportunity because they just weren't able to make a decision fast enough. So I think you want to do the work up front to become comfortable with the market, the sponsor, right? Do that vetting ahead of time, so you're not doing that vetting once a deal is put in front of you, an opportunity is put in front of you. And then number 8, just be decisive and act. I was in a cohort of folks when I went through some real estate classes, and I think probably 20% of us are probably still doing this today, or ever really got started. Most people just got stuck in an analysis paralysis, right? And just were never able to pull the trigger. I think you can only learn so much in classes, webinars, podcasts, books. At a certain point, you just have to take the leap, and you got to do it. And you'll learn 1,000 times more on that first deal, whether you're doing it yourself or you're investing with someone else. And honestly, investing with someone else is a great way to decide if you want to do it yourself later on. You will learn a lot by talking with that sponsor and understanding their process and learning from them. So, guys, I appreciate your time today. I hope this brought value to you. I'm happy to answer any additional questions. I know my contact information was at the front of the deck. You can email me. I'm happy to share any further information I can, or expound on anything. And as I said, my first goal is education. My second goal is access. And so it's providing access to those that don't want to do it themselves to great real estate opportunities. And so really, either of those will meet my mission and make me happy. So I appreciate you guys being with us today and for your time.
All right, Kent. Well, thank you so much for all of the great information and education you've brought to the table. I did jump back on the slide deck to our presenter slide that's got all your contact information. Guys, please feel free to reach out to Kent or myself if you're looking for any answers to either of our expertise. Please feel free to contact us. Check out Ritter on Real Estate podcast. He has great guests on that podcast and great educational information in his own right from his specific lane. Our lane is usually always centered in retirement account investing, or has some specific tie to retirement account investing. But Ritter on Real Estate is an all-encompassing real estate podcast, so you can learn a lot more in different things there. Ken, thank you so much again. I appreciate you for joining us. Appreciate you for bringing what you brought to the table. And I really love that note that you ended on as far as be decisive and act. Because again, coming from the self-directed angle, it is in itself, in the name, self-direction. The investors need to know what they want to do with their retirement money and call to action and bring to the table what that specific deal is going to be. So it's always important to make sure you have those ducks in a row and have the decisiveness, the comfort, the confidence that what you plan to do is going to work out, and you're going to do the best of your ability in your due diligence or managing the property if you're someone looking for a smaller deal and self-managing, that you don't worry about the what ifs or the what else's. You just do it and you learn and you build from there. I hope everyone's had a great time. Check us out next time. Thank you all so much.